These talks are brought to you by Claritax Books and are proudly sponsored by Six Forward Capital Allowances.
Welcome back to our series of talks on capital allowances. In recent weeks, we've seen why the signing of a fixtures election is essential for both buyer and seller. If the election is missed or if it proves to be invalid, the potential cost for both parties is huge. So today I'm going to show how to avoid many common problems that can arise. The statutory requirements for a valid election can be found at sections 198 to 201 of the Capital Allowances Act 2001 as amended from April 2012. Fundamentally, the election can only cover fixtures in the capital allowances sense. We looked at the meaning of fixtures in detail in Talk 8, but the essential point is to exclude movable items of plant and machinery. Tables and chairs, for example, are plant, but they are not usually fixtures. Including them in the election could well make it invalid with disastrous tax consequences. Another point to note is that Section 198 repeatedly refers to a fixture in the singular. Now, in practice, many fixtures will normally be combined into a single election, but the underlying wording must be respected if it will make a tax difference. If, for example, the election covers both integral features and other fixtures, these must be clearly identified and separate figures must be allocated to each. There's actually nothing to stop the parties from signing two or more elections in respect of different fixtures in the same property, though this is not necessary as long as the different categories are clearly segregated. If more than one property is being sold, however, separate elections should always be signed in respect of each property. But what will the election actually show? It must include the amounts fixed by the election and the names of those signing it. The parties must also provide their unique taxpayer references, or, in the case of a purchaser, a statement that the party in question does not have such a reference. This therefore allows a pension fund buyer, for example, to join in the making of an election. A non-taxpayer selling, by contrast, will not be able to sign an election, as it will not meet the condition of having to bring a disposal value into account per section 1981. The amount shown in the election does not have to represent market value or to be in any sense reasonable, but it cannot exceed the overall sale price of the property or the cost incurred by the vendor on the fixtures in question. The election is also subject to the restrictions that apply where other types of allowance, such as industrial buildings allowances or research and development allowances, have been claimed by a former owner. The fixtures election must include sufficient information to identify both the relevant land and the plant or machinery that it purports to cover. To identify the land, the title number should be included. To identify the fixtures, a number of different approaches may be used, but it's not sufficient to say all the plant and machinery in the property, as this will include items that are not fixtures. It is, in principle, acceptable to say all the fixtures in the property, but it would be prudent to add as defined at Section 173 of the Capital Allowances Act to avoid any misunderstandings. An alternative and generally preferable approach is to include a detailed schedule of the fixtures covered by the election. But if this is drawn up on the basis of expenditure incurred by the vendor some years previously, care must be taken to exclude any items that have since been removed from the property. Again, the schedule should be split, or separate schedules should be provided to distinguish between integral features and other fixtures. There are a few more points to bring out about fixtures elections, so we'll return to these next week before moving on to the topic of apportionments. Thank you for watching. I'm Ray Chidell. This talk was brought to you by Claritax Books and sponsored by Six Forward, an independent property tax consultancy working with accountants to to enhance capital allowances for their clients.